This is Bob Graham with Riggs Asset Management Company. Today I want to do another follow-on to the series of conversations we've been having about what's going on in the markets, what's going on in the economy, and how is that affecting our portfolios. I'll jump to the punchline. First off, across the board, whether on the fixed income side, on the equity side, your portfolios at Riggs are doing really well. So let's go talk about the economy and then the markets. Now, it's kind of interesting. We've gone through this, certainly what I'll call drama-driven market behavior over the last month and a half to 2 months. But when we look at the markets today and we look at the economy today, we're kind of back where we started. At the beginning of the year, the expectation is that the U.S. economy would grow, at the mid 2.5% range, 2.5% range. The most recent data coming out, whether you look at GDP Now, put out by the Atlanta Fed Reserve, or other predictors of U.S. economic growth, right now they're all in about the 2.5% range. It looks like interest rates are going to be relatively stable, maybe tick down a little bit towards the end of this year. But right now, when you look at the bond market, the bond market's pretty stable and is predicting sort of a status quo as we move forward. To put that in perspective, when we started the year, the U.S. Treasury yield, or U.S. 10-year Treasury yield, yielded 4.52% on the first trading day of this year. Today, the U.S. Treasury yield is 4.48% on the 10-year. You're literally talking 0.4% difference in the course of, 5 months now? So while there's been up and downs, we're kind of back to where we were at the beginning of the year. We had talked about the fear index, or the VIX. VIX spiked up during the initial discussions on the tariffs and what was going on with Liberation Day. But now we've seen that really settle down. Over the last few weeks, the VIX has been trading kind of in the 18 to 19% range. If you remember when we talked about it, we said anything below 18 was sort of low normal volatility. 19 to 30, 19 to 28 was really moderate, higher volatility. And then anything above that 28 range was really a high volatility range. We're really sitting on the moderate to low line and have been now for a couple of weeks. In fact, when you look at the stock market as measured by, let's say, the S&P 500, we're about 3.5% from its all-time high earlier this year. 16.5% off the bottom we saw in April. So we've seen a pretty good start to the year. Obviously, a sharp pullback in the markets, some movement in the bond market. But when we look at things today, we're kind of back to where we were as far as expectations, as far as the market, and looking at how things are structured. That economic growth looks like it's going to be in the 2.5% range-ish. The bond market looks like it has stabilized pretty close to where it was at the beginning of the year. And, when you look at the volatility in the U.S. stock market, it's kind of bouncing into the, moderate to low range, right on that line. So where do we think we are? Well, we think we're a continuation of what we talked about before. We're kind of, 2 steps forward, 1 step back, 2 steps forward, 1 step back. And we've seen that consistently since the April lows. We think this probably continues through the summer. We'll see how things go. It's not uncommon to get a pullback in the fall, and we would not be surprised to see that. But right now, when we look at the markets, we think the markets are in a good place. We think the economy is in a good place. The bond market seems to have stabilized. And while the headlines are, certainly, all over the place these days, when you actually look at the numbers inside the market, inside the economy, it's kind of back to a normalized environment. We don't see anything that's going to move the market in the near term strongly in one direction or the other We think it's just a steady grind higher, 2 steps forward, 1 step back. It's the way we're viewing the market. That's the way we're invested in the market. And as I said earlier, on the equity side and on the fixed income side, our portfolios have done really, really well because we were and did tactical shifts during some of the higher volatile period, and we're able to take advantage of the markets that we saw. Anyway, I hope this is helpful. If you have any questions whatsoever, please reach out to your Riggs team. We're here to help you in any way we can. Thank you, and I look forward to speaking to you again.